It's Tuesday, July 30th. I was asked the other day by a longtime friend, what are the macro themes at the moment for investors, traders, policymakers, consumers, and small business owners to keep in mind for the next year? Well, it's a long list. I'll keep it relatively short for the big important things that I've identified and give you a shorter list of some of the other stuff. Number one on the list is the US elections, of course, in November. They have great significance for the next 5 years for the largest economy on the planet. This relates to policy and regulation. The difference between the Trump administration and a Harris administration on policy and regulation will be huge. However, when it comes to the level of government spending, there doesn't seem to be much daylight between the two. No one is talking about balanced budgets, deficit reduction, debt reduction. The national debt has reached $35 trillion. Interest payments have topped $1 trillion a year. We are way into the danger zone on debt. And that's just federal, by the way. Tack another $5 trillion or so for state debt. We get into all kinds of serious numbers. Next on the list, I have monetary policy led by the Fed and an upcoming anticipated rate cutting cycle. Some central banks around the world have already begun easing interest rates as rates of inflation are well off their peak from 2022. Though the fight against inflation is not over. Stock prices rose in the face of a 500 basis point rise in interest rates since 2022. Where will they go when rates come down 150 to 200 basis points? I'm confident and comfortable saying that we're not going back to ZIRP or QE. ZIRP being zero interest rate policy and QE being quantitative easing. An unusual monetary policy put in place by Ben Bernanke in 2009, held in place till 2020. China is next on the list. The move away from China as the world's manufacturing hub is ongoing. The second largest economy in the world faces serious challenges, and their ascension to overtake America to be the global leader has been slowed. China has several crises to manage currently, from real estate to banking to high levels of unemployment for youth in China, excess capacity, agricultural challenges, and almost the end of the Belt Road Initiative as a result of horrible management and dealings between the countries involved. Next on my list is the forced transition by government decree from the internal combustion engine to the electric vehicle and the ongoing hysteria over global warming. We're making a huge mistake when it comes to public policy here. I suspect this will not come to fruition. I think people come to their senses and recognize we can't eliminate the internal combustion engine for dozens of reasons. But this movement represents a massive misallocation of capital that will be felt by hundreds of millions of households and millions of small businesses and severely disrupt a mature global economy. Next on my list is social unrest. Inflation, illegal immigration, religion, culture changes are ripping apart mostly Western societies, though the East has many of the same problems. The middle and lower classes are suffering around the world while the top 10% do spectacularly well and have the globe as their playground. And my last big piece of these themes is the work from home and a shortened work week have serious implications for productivity and output for the future. That leads to a reduction of on-the-job learning, mentoring, and skill attainment and retention. Real implications for productivity in the future. Other themes to keep in mind include commercial real estate and the impacts of work from home and reduced work weeks, diversity, equity, inclusion, and critical race theory pushback, the ongoing fight between brick and mortar and online access to goods and services, energy and the wars in Ukraine and the Middle East, and the role of AI in society. Some big picture stuff to keep in mind, macro themes as we move on to 2025. All right, let's get into my typical stuff I do on a Monday or Tuesday, a little look ahead for the week coming up in terms of economic data, a little snapshot of markets. Today, of course, Tuesday the 30th, the Federal Reserve Bank's FOMC committee, the Federal Open Market Committee, begin their two-day July meeting to decide if they will change interest rates. Here we're talking about interest rates on the reserves and the federal funds rate. The Fed will not change interest rates this week, though their policy statement will garner a great deal of attention and parsing. Fed Chair Powell will hold a press conference on Wednesday shortly after 2 p.m. For the last few meetings, the Fed has put out a rather hawkish, that is, a strong fight against inflation policy statement, only to be followed up by Powell doing a dovish, that is to say, not working hard to fight inflation, statements in his press conference. This is to mollify the algos in the stock market, of course, plunge protection. He started doing this at the December 2023 meeting, protecting the wealth effect. The Fed's experiment with monetary policy started by Ben Bernanke in 2009 has proven to be a large policy error and has really disrupted those who call themselves monetarists who believe in central banks. Their reputation has been harmed. They can heal their reputation by being disciplined and getting inflation rates back down to less than 2% annually in the medium term. No giving up on that fight. The only true solution for the Fed to get back to their core mission is for the U.S. Congress to change the Fed's mandate to just achieving stable prices. Of course, they have other responsibilities, like managing the financial system. But the dual mandate of stable prices and full employment must be put to an end. This is also Jobs Week. We get the July ADP employment report on Wednesday at 8:15, the private check writing company, unique insight into the hiring and firing of workers. Looking for 150,000 net change in employment for July. On Thursday, as always, we get initial unemployment claims. How many of our fellow Americans lost their jobs last week and had to file for unemployment insurance? And on Friday, the most important data point in the monthly calendar, the July employment situation report, where we get a look at the net change in non-farm payrolls, the U3 unemployment rate, the narrow measure, the U6 unemployment rate, the broad measure, the average hourly earnings for the month, and the average hours worked. Looking for a change in non-farm payroll is about 175,000. The U3 rate remained unchanged at 4.1%. Other data this week, for Tuesday, we get the July Consumer Confidence Index from the Conference Board. Wednesday, as always, at 7 a.m., MBA mortgage applications for the prior week. We also get this Q2 Employment Cost Index, June pending home sales. On Thursday, we get a look at Q2 unit labor costs and non-farm productivity. In June, construction spending. On Friday, we also get a look at June factory orders. So the rundown on data to look forward to for the week. Remember, we look at data so we can analyze the macroeconomic trends in the economy. This is important for you as a saver, as an investor, as a worker, as a consumer, as a small business owner. Always keep in mind and keep an eye on macroeconomic data. Before we head out for the day, let's take a quick snapshot of the markets. As I've said in the past, I'm a big fan of CNBC when I want to get my market information. My headline information, zerohedge.com, first stop every day. But when it comes to market information, CNBC is my favorite. Checking on the S&P 500, trading at 5,514. Watch 53.99 below and 55.05 above. Then above that, 55.56. Remember, good news and bad news is good for stocks right now. And it seems we're still likely in the buy the dip mode. Now, you notice I'm giving you these levels above and below the current price, right? This is technical analysis. I'm providing for you support levels and resistance levels from which you might execute or get out of trades. So in the lack of fundamental information, when we're trying to trade, we want to rely on technical analysis to help us make our decisions to reduce our risk. Checking in on fixed income, interest rates. The yield curve continues to be messy in the U.S. with inversion still from 1 month to the 7-year. The benchmark 10-year Treasury bond yield has dropped to 4.17%, wrong direction, well off the psychologically important 5% level, but reveals a little bit less concern about inflation and uncertainty about economic activity moving forward. Checking in on oil, West Texas Intermediate NYMEX crude currently trading at $75.19 a barrel, approaching the lows from June on a sharp slowdown in China. Watch support level 74.8 below and resistance levels above at 76.49. Checking on gold, currently trading $2,383 an ounce, has been range bound since May. The all-time highs are set in mid-July at 2,467. Watch support below at 2,327 and watch resistance above at 2,438. Inflation and uncertainty drive gold, just like crypto. Checking on FX, we'll use the US dollar index as our proxy. Remains range bound between 104 and 106. Currently trading 104.65. Watch support below at 104.09 and resistance above at 104.64. And foreign exchange and interest rates are closely correlated. Keep in mind the Fed's decision this week. The Dow Jones Commodity Index is approaching the year lows of 936, currently trading at 958. The July sell-off has been driven by a slowdown in China and a slowdown in EV adoption. Watch 940 below as support and 977 above as resistance. As always, keep an eye on headlines. Trump, Harris, U.S. steps to spending and debt, Russia, Ukraine, Israel, and all around her, including the Houthis from the southern tip of the Arabian Peninsula. Central bank comments and decisions, social unrest, Venezuela, China's slowdown and the rise on Taiwan, and AI disruption. Just to lead the list. All right, that's all I have for you today. Always try to buy American.